For a while, it looks like the company survived. From the outside, everything appears fine. The office is still open. The website still works. The press releases still sound confident. Founders still post optimistic updates. Investors still say, "We're excited about the long-term vision." But inside the company, something has already changed. The urgency is gone. The fear that once sharpened every decision has softened. After funding, survival feels guaranteed, even when it isn't. This is the most dangerous phase of a startup's life, because now, failure doesn't arrive as a crisis. It arrives quietly, slowly, disguised as progress. Expenses creep upward. Meetings multiply. Decisions take longer. People stop asking, "Do customers need this?" and start asking, "Can we justify this to the board?" At this stage, most startups aren't dying from bad ideas. They're dying from comfort. And the founders don't realize it yet, but the company has already entered the final phase. The collapse just hasn't become visible. Not yet. When startups fail after funding, founders often say the same thing: "We didn't realize how fast the money was going." But the truth is, the money didn't disappear suddenly. It leaked, one hire at a time, one tool subscription at a time, one expanded office lease at a time. After funding, spending feels justified. A senior hire feels necessary. A new department feels strategic. A bigger burn rate feels normal. The problem is scale. Every new expense raises a company's survival threshold. Now, the startup doesn't need some revenue. It needs a lot of revenue, fast. And when growth slows, panic doesn't happen immediately. Instead, founders delay hard decisions. They tell themselves, "Next quarter will be better." The product just needs one more iteration. The market timing is slightly off. Meanwhile, the runway shortens, not because of one big mistake, but because of dozens of small, reasonable ones. By the time leadership admits there's a problem, the numbers are already unforgiving. The money didn't run out. Time did. Early on, the board feels supportive. They encourage experimentation. They praise ambition. They talk about vision. But as burn rate rises and growth slows, the tone changes. Questions become sharper. Why hasn't this metric improved? Why are costs still increasing? What's the path to profitability? Founders feel the pressure, even if it isn't said directly. And here's the shift most people don't talk about. The company stops being run for customers. It starts being run for board meetings. Decisions are shaped around slides, not reality. Metrics are framed carefully. Bad news is softened. Risks are delayed, not solved. This is when internal honesty begins to erode. Not because founders are dishonest people, but because fear quietly enters the room. Fear of losing credibility. Fear of disappointing investors. Fear of being replaced. And once fear shapes decisions, clarity disappears. Every startup expects growth to slow eventually. What they don't expect is how disorienting it feels when it happens. User numbers plateau. Revenue flattens. Churn creeps upward. Nothing looks catastrophic, but nothing looks hopeful either. Founders respond the only way they know how, by pushing harder. More marketing, more features, more urgency. But pressure doesn't fix structural problems. It amplifies them. Teams work longer hours without clear direction. Morale quietly drops. Top performers begin to disengage. This is where many startups make their final mistake. They confuse activity with progress. The company feels busy, but the fundamentals aren't improving, and investors can see it. They may not say it yet, but they know. The best employees always notice first. They see missed targets. They hear internal contradictions. They feel leadership uncertainty. And quietly, they start updating their resumes. This is the moment that accelerates collapse. Because startups don't fail when average employees leave. They fail when the right ones do. When institutional knowledge walks out the door. When belief disappears. Leadership often underestimates this damage. They tell themselves, "We'll replace them. We still have a strong team." But momentum is fragile. And once it breaks, rebuilding it is nearly impossible. With runways shrinking, founders reach for the last lever. The pivot, a new market, a new pricing model, a new positioning story. Sometimes pivots save companies, but most late-stage pivots aren't strategic. They're panic responses. The team doesn't have time to validate. Customers are confused. Execution becomes rushed. What was once a focused vision turns into fragmented effort. And now, the company is fighting on multiple fronts, with fewer resources than before. At this stage, something strange happens. People stop asking hard questions, not because they don't care, but because they already sense the answer. Meetings become shorter. Debate fades. Optimism sounds forced. This silence is louder than panic. It means belief is gone. Founders hope for a bridge round, a small extension, a temporary lifeline. But investors are rational. They don't fund hope. They fund momentum. And when momentum disappears, so does capital. What follows is brutal but predictable. Terms worsen. Valuations drop. Control shifts. Some founders accept survival at any cost. Others walk away. Eventually, the math becomes undeniable. Payroll dates approach. Cash balances shrink. Options disappear. Leadership gathers. And for the first time, they say it out loud. We don't have enough runway. Not next year. Not next quarter. Now, the message to the team is careful, grateful, respectful, measured, but the impact is immediate. Shock, anger, disbelief. People who gave years of their lives now face uncertainty. This is the human cost hidden behind startup headlines. Systems are turned off, access revoked. The company that once promised disruption disappears quietly. No breaking news. No final celebration. Just silence. Later, people will say the failure was obvious. Bad timing. Bad product. Bad leadership. But reality is messier. Most failed startups were almost successful. And that's what makes this story dangerous. This cycle repeats across industries. Different founders. Different markets. Same ending. Funding didn't save them. It delayed the truth. So the real question isn't, why do startups fail after funding? It's this, why do we assume funding means success at all? In the next part, we'll examine the startups that escaped this cycle, the decisions they made differently, and the warning signs they refused to ignore. Because some founders saw this collapse coming and acted before it was too late. One document, one decision, one moment when everything could have changed. Most founders missed it. A few didn't. And the difference was everything.